Welcome back, everyone, from the Wall Street Silver community. We have a special friend with us, Stephen Van Meter. He's the inventor of Portfolio Shield and Macro Fund Manager and the host of The Macro Show on YouTube. How are you doing, Steve?
I'm doing great. Thanks for having me on, Ivan.
Awesome. We're super excited. We're going to get into a bunch of questions. We also have Jim Lewis and Lee Justo from the Wall Street Silver community.
I've been following your channel for a couple months. I really appreciate how you kind of dive deeply into a lot of the numbers. Your perspective on things seems to be a little different. You're almost like a contrarian to our view on inflation and everything. So I think we could start it off by talking about the Fed and the quantitative easing, and they're printing money like crazy, but it's not really getting into the system. Why don't you go into a little bit of detail on it, if that's okay?
Sure. Yeah, it's interestingly, I get called a contrarian, but really I'm just a guy that looks at how the system works. Apparently, knowing how the system works these days makes you a contrarian. So, there's a big misconception on quantitative easing, the public perception, and it's even sort of promoted by the Fed. We heard on a 60 Minutes episode that Powell said we're printing digital money. And it wasn't until the next FOMC meeting when during the interview section where he was pressed on that statement, and then he, quietly said, "Oh well, this is what we're really doing," which is what we know. And all he said was, "We're changing the nature of the reserve." And what he was referring to is banks create reserves. Now, what does that mean? Why do they do that? So, when we deposit money in our bank accounts, we're expected to earn interest on it. Well, where does that interest come from? Where do the banks get it from? And they don't, it's not coming out of their own generosity. Well, normally the way it works is either banks take our deposits and lend it out and use the interest to pay us some and capture the spread. But if they don't have enough lending demand to meet all their deposits, they can also go out and buy treasury securities. And what we find out is, depending on the type of deposit, whether it's a retail customer or a commercial deposit, there's different timeframes to what the bank knows how long our money is going to be on deposit. And so all they do is they go out and they buy treasury securities, and that's where they get the interest. So if you've ever wondered why you're getting, I think I'll even look, because it's not even worth the ink printed on the paper, but it's somewhere below 0.1%. Well, it's coming because it's coming from their average weighting of their portfolio. And it's really coming from the rate of interest the Fed pays on reserve. And that's where we're going next. So what will happen is you'll see the banks backing these deposits, not only the commercial, but again, the retail deposits. And the maturity on that will range, so it's depending on it, 3 to 5 years. So what we see banks predominantly buying is anywhere from 4-week T-bills all the way out to 7-year treasury notes. And from that, they create a blended average. So what the Fed is coming in and doing is saying, okay, and we'll just take maybe a 5-year note, for example. The Fed's going to come in and say, hey, bank, I'm going to take that reserve that you've created. Now, mind you, it's tied to customer deposited money. That's where it originally came from. So it's not money. So that part's not money printing, didn't come out of thin air. And the Fed's going to come on and says, okay, I'm going to switch that with you. I'm going to take that 5-year note off your hands. I'm going to put it in my, our balance sheet. That's what we look towards. And we're going to remove it from the financial system, but we're going to give you something in exchange. Now, one of the easiest ways to understand this concept is back when I was a kid, there were arcades. And you would go to the arcade, you'd put your money in the machine, you get arcade tokens. Now, if you had extra arcade tokens when you were done, maybe because your mom was calling in or something, it's time to go home, you either had to play them real fast, find someone coming in the door to trade them with, because they weren't useful anywhere else. You couldn't go down the street and buy a hot dog with them because nobody would accept it. So what happens now is the Fed gives the bank what's called a reserve asset. And reserve assets are an overnight duration bond. So we're taking a 5-year duration bond, removing it and swapping it with an overnight duration, and those overnight duration assets pay 0.1%. Now, what's also interesting about this overnight asset is it's held at a Federal Reserve member bank, meaning the commercial bank can't sell it. They can't do anything. They can trade it. So, for example, if I'm a bank, Jim's a different bank, and Lee, you're a different bank, at the end of the night, there's money moving between our different banks. We can settle those with reserve assets. So I might owe, Lee, a couple billion, and I could say, here, take some reserve assets, and you go, great. and they can move inside the system, just like the arcade. You can move them around the system, but you can't take them out because the bank can't sell them because they're not theirs. Now, the bank can account for them on their balance sheet. So from an accounting standard, we see the swap, we look at the statements, and we can say, yeah, everything is the way it's supposed to be. But remember I said that original bank reserve was tied to customer deposits? Well, when we swap it, now what happens? That customer deposit is tied to a reserve asset. Remember, that reserve asset can now only move inside the commercial banking system. Now, if you're wondering why that is, your local community bank, your credit union, they don't transact in reserve assets. So it doesn't work that way. So this money gets trapped in the commercial banking system. So when you hear people make that statement, that's what they're referring to. They may not know exactly what it means, but what it means is if we look at the small number of commercial banks that actually can handle holding reserve assets, and they're the ones that actually participate in the QE purchases, all that money gets eventually trapped in what I call dollar prison. It can only move inside those banks. So what we perceive as money printing is actually not. It actually has some other effects that we can get into if you'd like.
Yeah, please.
So one of the other big misconceptions, and before I keep going, does that make sense? You guys have questions? Is because a lot of the primary dealer banks are owned by commercial banks. So we get confused, and that's why there's a step that's omitted. And so what you're hearing is exactly kind of what the mainstream view that's being circulated. So what happens is at a treasury auction, primary dealer banks bid on treasuries. And what the whole purpose of a primary dealer bank is, you have to think of them as a retailer. They're not holding inventory specifically to make money on it. Their job is to buffer the issuance of these auctions and sell those treasuries out to the market. So that way, instead of having, say, 4 10-year treasury note auctions a month, the treasury just has one. And the dealers know that there's going to be other people that need them along the way. Now, the Fed is not buying the bonds from the primary dealer banks. Again, it's a reserve swap. The primary dealer part of this equation, they're not creating bank reserves. They would have no reason to. They don't have deposits to back with it. What they are doing is selling them to the commercial banks, who are a customer, which happen largely to own them, and they're using customer deposit to buy those. So that when you factor that missing step, then it starts to make sense, because the way the primary dealer banks typically get these bonds from the treasury is they're not actually paying with their own cash. They will take an existing perhaps reserve asset from their parent company and post it as collateral. And then as they sell those securities, then they give the US Treasury the money. So it's not like the dealer banks have hundreds of billions of dollars that they're just sitting on that says, gee, I can't wait to buy all this debt. No, they're literally just moving it. And if you've ever worked at a company where you bought something and you get the bill and it says like a net 30, net 60, net 90, what does that mean? It's the same as cash. Look, if you pay us within 30, 60, or 90 days, whatever the terms are, everything's cool. And that's effectively what we're seeing here is the dealer banks aren't outlaying cash because the treasury doesn't have an instant need. It's not like the treasury is running its balance sheet down to zero. It generally runs a 300 to 400 billion buffer. And if you look at the weekly holdings of the primary dealer bank, it's nowhere near that. So it's just set up for them to buffer. But that when you take that missing step of the dealer selling it to the commercial bank, then you realize that, okay, it is a reserve swap. It is exactly what we know it to be.
At some point in the process, though, the Treasury ends up with, like this year, just for using round numbers, and I'm rounding up to the nearest trillion because the numbers are becoming so ridiculous, we're going to collect roughly 4 trillion in tax revenues this year. We're going to spend, with all the extra stimuluses that have been approved, we're going to have a $4 trillion deficit because we're spending roughly $8 trillion. And they might approve a few more. So we're spending an extra 4 trillion. Where is that cash coming from if it's not being printed by the Fed?
It's being borrowed. Right. So if you look at the treasury auctions, there's three groups that bid on it. They're the primary dealer banks, so we've already covered them, but they're not bidding to hold, they're bidding to resell and make a profit on it. There are what are referred to as direct bidders or domestic to the United States bidders. They're usually a smaller portion. And then the largest portion, predominantly, depending on the auction, you'll see 50 to 60+%, is what are referred to as indirects or foreign bidders, so outside the U.S. So what you see that sometimes looks like money printing, because you can look at the monetary aggregates, the M1, the M2, and you say, wow, there's this big spike. Where is this? It's got to be money printing. Where did it come from? Well, it's coming from sources that aren't recorded or reported to in the M2. We don't report, cash in China, dollars in China or dollars in Japan or dollars in Europe is part of our M2. It's a domestic money supply. So all the money that we're short is being borrowed. It's all just deficit borrowed spending.
So the federal government is basically borrowing the money from the Fed?
No, they're borrowing it. No, they're borrowing it from effectively domestic and foreign banks, governments, just like we've always done.
Okay,
all the Fed is doing is just changing the nature of the reserve.
So of the current Fed balance sheet, last night it's like in the high 7 trillions right now, and it's about what, 5 trillion in government bonds and 2 trillion, in corporate, mortgage-backed securities. At least those are just round numbers. I'm probably off by a couple $100 billion.
Yeah. But what is a couple $100 billion?
Well, hey, it's a rounding error at this point. But okay, so I want to know, why is the Fed, if all of this is just reserve swapping, what's the need to be doing reserve swapping then, if it's not having any real impact?
Well,
what is the need for the Fed's balance sheet to be increasing by $7 trillion, almost 8 trillion in the past 13 years, if it's not really, if you say it's just some reserve swapping? And I'm really honestly trying to understand this.
Yeah, no, you could have asked me a better question.
Deep down, I'm extremely skeptical that none of this money enters the system, as you're telling us.
Right, it doesn't, because if you look at these reserve assets, they're held at a Federal Reserve member bank. They can't get into the real system. It's not possible.
Well, do those reserve assets allow them to loan more money?
Well,
what do those extra reserve assets allow them to do?
Yeah, so let's go, again, you set up a great question. I couldn't have asked you to give me a better question. So what is the purpose of QE, and what can or can't you do with these reserve assets? So let's start with, what is the purpose of QE? The whole point of QE is to lower interest rates. Now, the Fed has two policy tools. They have the federal funds rate and they have QE. And they both do, ironically, the same thing. And if you look at what the Fed can do, they're like a golf cart. It's forward or reverse. There's no gears. There's nothing. You're going one direction or the other. And so the Fed can either raise interest rates or lower interest rates. But when you put the federal funds rate at 0, well, what if that's still too high and you need to bring rates down? How do you do that? Well, you do it through quantitative easing by purchasing various securities across the curve. If you're trying to lower the short end, you buy more bills. If you want to lower the long end, you buy more notes and bonds. It just depends on what you're doing. So the whole purpose of QE is to lower rates. Now, you might say that, well, wait a minute, but we've seen kind of rates go up during this. Well, yeah, but that's because you're seeing the largest selling event in the Treasury bond market in history, and a massive amount of speculative selling. So it's not specifically that the Fed is out there trying to stop everything, but the overall objective of QE is to lower rates. The second objective, and why would the Fed want to do that, right? Because what's the Fed trying to effectively do? Create inflation. How do you create inflation in our financial system? Well, you have to have new dollars being created. Well, there's only one way dollars are created, and that is when a new loan is originated. So when a new loan is originated, dollars are created into the system. So as a consumer, how do you get, say Steve and Lee, Jim, Ivan, how do you get all of us to go out and borrow more money? Do you do it with higher interest rates or lower interest rates? Well, the obvious answer has been lower interest rates. So and why is that? Because all the Fed's trying to do is what's called pull aggregate demand forward. So for example, let's say all of us buy a new car every 5 years, and we all are 4 years into our existing car. And how do you get us to go out and buy that car a year ahead of time? Well, you lower rates, you get us all to believe that rates are never going to be lower. This is the best deal around. And we pull that demand forward from 5 years to 4. And hopefully, if you pull enough demand forward, then you get the economy going and everything goes just fine. So the primary reason is to lower rates. The next reason, when we talked about that dollar prison and dollars getting trapped in the financial system, is what's another way you get people to spend? Well, if my dollars are getting weaker, then where's my consumption going to be? It's going to be domestically. But as a world's reserve currency, which the dollar is, domestic consumption doesn't help because most of the dollars that are created outside of the US in what's called the Eurodollar system. So that's where foreign banks are issuing dollar-denominated loans. So to get the real cycle working, which I refer to as world dollar liquidity, you need to get dollars in the US out of the US. Well, how do you do that? Well, instead of maybe going out and buying an American-made car, maybe that's what we're all looking at because the dollar is relatively weak and that encourages domestic consumption. Well, if the dollar's now strong and interest rates are low, we might say, hey, now we can go buy that German or Japanese car or whatever that we always really wanted because we can get a pretty good deal on it due to the strength of the dollar. And that's the whole objective here is if you get the dollar strong enough and you get rates low enough, you spark consumption, dollars start moving out of the US into the foreign economy where they start to multiply. Then those dollars are cycled back to the US through borrowing. So when the US borrows money and we pull a lot of it from foreign sources, it comes back to the treasury. And so you start creating this cycle. Well, when the cycle breaks, the way you fix it is you effectively step in and you buy treasury securities. So what the Fed is trying to do is get that cycle going. Even though this isn't the best way to do it, it's what they're trying to actually do. So those are the two objectives of QE. And given enough time, as we've seen in Japan, you can beat out the seller. So in the short term, we haven't really seen the full effects of this because we can say, well, the dollar's weakened a bit and interest rates are still up a bit. But given the massive selling against the dollar in the bond market, it's pretty impressive that rates aren't higher and the dollar's not a lot weaker. So that's really what the purpose of QE is.
But so far, aren't we seeing the end result of all these extra reserves in the bank system? It's leading to corporates taking out massive amounts of debt. That's the primary source of new dollar creation, and then they're going and doing things like stock buybacks as opposed to investing into the economy. Is that where a lot of this is happening? And then we see asset inflation from massive. Is that what we're seeing right now? Not the targeted type of economic activity that perhaps policymakers would want to see?
Well, the Fed doesn't really control what people do with their money. So if a corporation is borrowing money, I mean, if it's particularly a large corporation, because what do you have? You have the banks want to lend to the most creditworthy, but there's not a lot of creditworthy people, relatively speaking. So if Apple comes along and says, hey, I want to borrow, or Amazon, right? I want to borrow 12 or 18.5 billion. Yeah, sure. Is that all you want? We'll give you more. Now, if they choose to buy their stock back, well, that's their choice. So that isn't actually, quantitative easing isn't trying to incentivize that. It's just the corporations have nothing else to do with their money because the overall economy is rather weak.
Or MicroStrategy wants to take out a few billion and buy Bitcoin for Michael Saylor or something like that.
Yeah, you've got it exactly right. But one of the problems with low interest rates is low interest rates are deflationary. And the reason that is because when you look at a loan, right? So let's say we'll come back to financing a car. So if we're going to all go out and buy a $60,000 car and we're going to finance it, let's just make the interest rate real high. We'll just say it's 10% for whatever reason. Well, as we pay off that loan, the interest stays trapped inside the financial system and the payments are destroyed. So when a new loan is originated, it creates money. As it's paid back, the principal value is destroyed. So interest stays in the system. So now let's go to a zero interest rate loan. So now we have a 60-month loan, $60,000. We're all paying $1,000 a month. So we borrowed $60,000, $60,000 was created, and then every month thousands destroyed. At the end of 5 years, all that money's gone. It's all been destroyed from the financial system. So the problem with 0% interest rates is not only does it get misused, but you have to have such a massive amount of money being borrowed and then perpetually, not just once, but month after month after month. Because as it gets paid back, it destroys money and it's inherently deflationary. So we're effectively like a dog chasing its tail here. We're lowering rates to get people to borrow. The problem is that low rates are inherently deflationary because there isn't actually enough borrowing because there's nothing worth, there's not a lot of productive uses. So you see corporations borrowing and buying their stock back because, hey, there's just not enough demand. There's nothing else to do. So you get these weird effects, but the directive point of QE is not to create asset inflation. It can do that, but the other side is it Fed can't keep asset prices up. They have no control over that. So you can still see, like we saw last March, where asset prices fell 30%, and we were doing QE then. We did more, but what happened as a result of that? What did we really see? You saw margin debt spike to new all-time highs as people borrowed money. But what did they choose to do with it? Buy stocks. It wasn't because the Fed told them to. It's just what they did.
It's chasing yield nowadays because there's none out there.
Yeah. Well, but here's the thing: is what's interesting about QE? It's deflationary until it becomes inflationary. And so what I know that sounds odd, but what does that mean? It means that what the Fed is effectively trying to do is deflate the economy, which is by lowering interest rates, because lower interest rates are, as I just explained, deflationary, until it spurs enough lending demand. So now we have to go look at the lending data. And what do we see on a year-over-year basis at all loans and leases at all commercial banks? It's in contraction. So money's being destroyed. It's not being effective. So what happens is you get deflation. Now, if you're looking at precious metals, which I am bearish in the short term, bullish in the long term, and let me explain why, is because if there's a deflationary crash, well, guess what happens to precious metal prices? They usually crash too. It's what happens afterwards that gets really exciting. And if anyone is curious about that, I'll say go back and look at the great financial crisis. What happened? Interest rates collapsed, bond prices shot through the roof, precious metals and stock, everything else went down, and the CPI went negative on a year-over-year basis. And then go look at what happened. Take GDX, for example. I know we want to talk about silver, but I happen to be familiar with the numbers on GDX. It went up like 300% in 2 years. So you take your bond profits and flip into precious metals. That's why I said I'm short-term and I'm bearish until this deflationary crash happens. And then I'm going to be as mega bullish on precious metals as maybe the three of you combined.
Nice. That's good. That's good.
So what can the Fed do to change this? I mean, it just seems like they're just in self-destruct mode, no matter what angle you look at it.
What choice do they have? Again, they're a golf cart. I can either raise rates or lower rates.
Why don't they raise rates?
So what have they done? They've convinced the entire world that they need to lower rates because they're actually, in their words, easing financial conditions. But oddly enough, lowering rates, as we talked about, doesn't ease at all. It tightens them until you get enough money created. So if the Fed were all of a sudden to come out and be like, hey, you know what, we had this all wrong, all this, for years we've had this wrong. For 40 years we've been wrong. We're going to start raising rates. Man, that would not go over well at all. So the Fed, it seems like we're going down the wrong path, but the problem is they've convinced the world that this is the direction we go. So the only thing they can do is to keep doing what they're doing.
Is there an off-ramp to this process? I mean, no one believes that they're going to raise rates right now. There's simply too much debt in the system. If they even hinted that they're going to raise rates, the market's going to crash. But all they're doing right now is more of the same, which doesn't appear to be working.
See, Jim, that's the brilliant part of all this. You just said it. Okay, so what happens if we raise rates? You kill the economy, right? Credit's already contracting. And I'm already destroying dollars. And so let's say we raise rates back to where mortgages are 7% and car loans are 10, what's going to happen to the economy? Self-destruction, right? It's just going to implode, explode, go supernova. I mean, it's done, right? It's over. Okay, so we can't do that. So what's my alternative? Well, I'll just keep lowering rates. But I just explained that if you keep lowering rates, it's deflationary until it creates lending growth, which we're not getting. So guess what the alternative is? You crash the economy. You have effectively another financial crisis. So no matter what you do, the Fed is going to lose. Yeah. And that's what's really brilliant about it. When you understand their two options are both terrible, like it's just a matter, it's not an if event, it's a matter of when it all falls apart.
Well, how would you fix the system?
Well, that's a tough question. I mean, the real way to fix it would be is you need a lot more banks. So if a lot of people go back to the 1970s and say, wow, there's a lot of inflation, then we're going to get that now. But one of the big differences, and this was one of those, light bulb in the middle of the night, wake up and like, aha, it makes sense moments, was I was thinking about, okay, well, how is money created, right? It's created when we borrow money. Well, how do you get inflation from that? Well, it's when I borrow money and maybe, Lee, I pay you for a service and you bank at a different bank. So you deposit there, and now guess what? Your bank can lend against that. So then maybe you borrow some money and pay Jim for something, for a service. And then he deposits it in yet a different bank than the two of us. And now that bank can lend against it. And then another loan's created, and now Ivan's getting paid. And so all of a sudden, money is start moving around the banking system. If you go back and look at how many banks there were in the late 70s and 80s, it was tons. And if you're young enough to or old enough to remember, you'll remember there was interstate banking laws that effectively limited banks. They couldn't go across state lines. And so you saw a ton of these little, 1 to 3, 4 branch banks, and they were all over the place. And I remember as a kid, we're going over to this bank. Why? Well, this, your parents, right? This bank has better deposit rates on this. Well, why are we over here? Well, this bank has better that. And as a kid, you don't know, but there's a bunch of them. Today, the four of us could probably name every major bank easily because there's that few of them. And if you look at how many banks, commercial banks are around, there's not very many. So the first thing I do is perhaps change the laws, put back the interstate banking laws, break up the big banks, and create a ton of banks. And I don't have any math to quantify this, but if someone super smart would ever do the research, my bet is that you need a certain number of banks per, or a certain one bank per each, so many people population. So somewhere maybe out in the Midwest where there's not a lot of people, you don't need as many, but in LA and San Francisco and New York, you need lots of separate banks because you need that money to move around. That would be one of the first things I do. And then once I did that, then I would start raising rates slowly. I mean, you're going to have to do it. You're going to have to eat the pill and just say, look, this isn't going to go well. But if you think about, how economies are reborn out of recessions, it's because finally asset prices come down and people can actually start affording them. People that couldn't ever buy a home because of way out of price, now maybe they can buy a home, maybe they can get some other stuff. And the healing process takes time. But, sometimes you have to, prune the bush, that's dying and water it and fertilize it, and then it starts growing again. And that's the way I do it. And then I start steadily raising rates until I got them to a nominal level, and then I'd leave them there and maybe make minor changes. None of this, higher and lower. And then eventually I would want to unwind the balance sheet too. I would want to, instead of doing QE, I want to do QE, stuff the banks full of all this money and force them to do something with it, get it out of there and get it moving around the economy. So it can be done, but the path we're on is never going to work the way the Fed thinks.
Can we just look at this from another angle? Let's talk about why there are so few banks. From my perspective, we've had so much M&A activity over the past probably 50, 60 years, where we had and it's not just banks, it's in pretty much every industry. We had all these mom and pop stores, and now we just have like these big retailers, and it's gotten even worse and more accelerated with the internet coming out. Would you attribute that directly to Fed policy and interest rates and kind of like the people at the top getting the better interest rate loans?
But potentially, I mean, from the Fed's perspective, Janet Yellen has actually publicly stated that fewer banks are easy to regulate than more banks. Well, she's exactly correct, right? But that doesn't solve the problem. The other issue is, you're right. I mean, small businesses, it's darn and near impossible for them to compete because a lot of these large businesses, they have access to effectively an unlimited amount of credit. They get tax breaks for everything. I mean, if I had some technology that Apple wanted, they could either hire people to try to recreate it, or they could just throw some stupid number at me until I capitulate, because they can just go make so much more money. I mean, if you look at antitrust laws, I mean, we're effectively letting companies just get bigger and bigger and bigger and swallow a lot more and more of their competitors, and we're doing nothing about it. I mean, if you wanted to create jobs, like I said, start breaking up companies, because then you need another president of the company, another HR department, you need another corporate office, you need a new name, you need new advertising. I mean, you start looking at how many jobs you can create. But if you have one mega company, well, you don't need as many people because you can do it extremely efficiently. So, the landscape for inflation and what's going on, I mean, you look at zero interest rate policies, and it's not, you can't just say, well, the Fed is creating this, it's leading to it. I mean, if rates were, say, at 7-8%, you wouldn't see corporations doing this. They wouldn't be able to handle all this massive debt they have and then still go out and get more. They'd be forced to kind of behave normally. But because some companies have this privileged access to getting whatever money they want, they just swallow up their competitors, and nobody seems to care.
So do you see all this, I guess, bank reserves would be the proper, I mean, is this what's causing the markets to go up so much? equity markets over the past, we've had that bull market since 1980, I believe.
Yeah, so
Is this
there's a
like a side effect of
misconception
that?
that reserve assets cause asset inflation. It's just a function of what people are borrowing money and doing with it. So, you go look at the great financial crisis, people are borrowing money and buying homes. Now we're seeing people borrowing money and buying stocks. I mean, it's again, the Fed isn't controlling what people are doing with the money. I mean, it's like I said, being at an arcade. I mean, the arcade can't say, well, you're only going to play this one game unless every other one is broken. But here's your tokens, do what you want. Well, the 3-4 of us are like, we all want to play that game. So we're all fighting over it. And then actually, boom, the cost to play goes up because, people were bidding. Oh, what's my turn? Well, you have to buy me my position out. Meanwhile, we could just go play something else and no one cares about it. But yeah, it's just a question of, how people are using that. And people like bubbles. I mean, people, you think we'd learn after two major bubble pops and, recessions since 2000 that people would learn the lesson, but they like them and they keep driving asset prices up, chasing them higher rather than sitting back and say, look, I'll just stack up cash, let the bubble burst and I'll come in and get rich. And if you look at how wealthy people got wealthy, they didn't get rich at the top. They got rich at the bottom. I'm very, very few people you ever hear like cashed out at the top. Occasionally you hear a story like that, but true wealth, generational wealth, created by mopping up and during recession. So I mean, people should want it to pop, but no one does. They want to chase it higher until it gets too big, and then eventually it bursts because there's not enough money to support all these asset prices.
So it sounds like you're heavily in cash now, or?
Oh, no, I'm a bond king, man. Because what is a bond? It's just a deferred dollar. So a bond is just a leverage play on cash. So absolutely, I'm huge in bonds because what happens to interest rates during recessions? They go down. They go down substantially. And given what's going on, my view is we're going to see the entire curve probably go to zero or parts of it go negative. Well,
so
if that happens,
flat yield curve.
I'm talking about the treasury curve, from 0 down to 30. I mean, I don't know if the 30 will get to zero, but I think it's going to get pretty darn close. Could it go negative? Yeah, it's possible. People think, well, how can it happen? Look, all the Fed has to do is come to the rescue and buy a whole bunch of the long end and drive rates down, just long enough for me to hit that sell button. But if that happens, right, you get this deflationary crash, Fed comes to rescue, rates crash, and boom, next thing you know, you've got money to go in and mop up. And that's how you change your future is, you don't get rich, you don't, buying homes at the top, cars at the top. You got to stack up cash and be patient, and then hit the cycle on the low, buy the bottom, and then rinse, repeat. If you do it once, it'll change your life. If you do it twice, you'll change your kids' lives too.
So, could you see them tanking the stock market to drive kind of a flight to quality, to lower interest rates, where people just flow into bonds?
Yeah, absolutely. I mean, that's kind of what happens during the deflationary crash. I mean, you go back to the great financial crisis, Lehman Brothers, right? When they failed, it was like, whatever. I mean, that's a one-off deal, right? And the next thing you know, Bear Stearns, and then next thing you know, the whole system came down. So what happens is, and this is what gets interesting, is you think about what the Fed's trying to do, right? They're trying to lower rates, strengthen the dollar to get the world dollar liquidity cycle working, get dollars out of here into the foreign economy, and then cycle it back and get the machine running. But what happens when you take a whole bunch of dollars, 120 billion of them a month, and lock them down into the commercial banking system where you create a dollar shortage? And when you have a massive amount of debt, it's like musical chairs, right? So if four of us play music chairs and there's three chairs, we already know one of us is going to lose when the music stops. We just don't know which one. And we're all hoping we're faster than the other person. And that's what happens in a liquidity, in the great financial crisis, when there's a dollar shortage, and you get that from QE, is you have all this debt. And eventually there aren't enough dollars and somebody can't pay. And then we go, it's no big deal. Lee didn't have much money anyways. He was going to, that idea he had was nuts. He was never going to, that was never going to work. But then next thing you know, we're like, wait, why is Jim failing? Like, Jim's been, he runs a solid shop. He's run a good business. He's like, what's happened there? And the next thing you know, Steve's gone and Ivan's gone. And next thing you know, people are defaulting left and right because there isn't enough money. And so in a debt-based economy, there's never enough money to pay on the loans to begin with. If we took all the money and paid off all the debt, there's still more debt. But when you tighten dollars down and you kill the velocity of money, as we've seen by creating this dollar prison, you're almost ensuring that somebody is going to fail. And the more you do it, the more people are going to fail. So it's an unintended consequence. So when I see all this margin debt in the stock market, I kind of like, oh yeah, that's going to go up like fire. And you start looking at all this other debt, people are like, well, there can't be a housing crisis. Well, there can be if there's a lot of debt in particular sectors. No, there can't be a problem with cars. Yeah, if there's a lot of bad debt in subprime cars, look, it's just a matter of time before this goes. And the pandemic did something really weird. We said, hey, don't pay on your student loans, don't have to pay on your mortgage, maybe you don't have to pay on your rent, don't have to pay on this, don't have to pay on that. And that kind of gave us a pass for a while. But as all that comes back, we're going to find out there's a massive global dollar shortage, because what we did with all this deficit spending, kind of coming back to some of our original conversation and some of the questions you had, Jim, is we're taking dollars outside of the U.S., which we desperately need out there to keep all that debt floating, and we're just bringing it into the commercial banking system, and we're locking it down, 120 billion a month, 120 billion a month, and we're going to keep doing that until the whole thing breaks. So it's exactly what happened before, and exactly what will happen again. So
this sounds like the milkshake theory to me.
It's interesting because when I first met Brent, and I knew of his milkshake theory, but I didn't understand it very well. And kind of the nice thing is, because he interviewed me, we became friends, and I got to really get into the details. And what we concluded is that there's a huge amount of similarities. It's just where we're both unsure, and where he's actually gone the path is what happens afterwards.
A lot of us are very familiar with the milkshake theory, and if any of our audience isn't, you need to go read about it. But tell us where you separate from Brent on the milkshake theory.
Oh, well, we're separated is okay. So everything crashes. How do we create inflation? And effectively, Brent, I'll just simplify it, because the Fed can't print money legally. There's no legal component. Federal Reserve Act can't print money. U.S. Treasury can't print money, but foreign central banks can. Certain ones can't. They actually have the legal authority in their country to print money. So his theory is that you'll see a foreign central bank print money, and because of the dollar cycle, meaning U.S. consumers need to spend money abroad, that what they will come in and do is they will swap that for dollars and buy U.S. equities to drive asset inflation, to give the wealth effect to Americans who will hopefully, feel wealthy and go spend their money. The only place we break on is I've never bothered to come up with an in-game theory, because there's so many of them from so many people, and a lot of them have, great credence. I mean, is Brent's theory absolutely valid? Yeah, it could happen, but there's so many other good ones too that I just kind of got excited about, like, hey, I'm going to do this, sell bonds at the top, flip down and buy the inflation-sensitive assets, your metals, miners, things like that. Make a whole bunch of money, and then I'll worry about it after that.
So U.S. dollar and its purchasing power, I mean, it's just been going down since, the 1930s, really.
Yeah.
So where do you see it going? I mean, we have the World Economic Forum talking about the Great Reset, and then we also have the Fed talking about the digital dollar. I mean, where do you see that going? And
yeah, there's a lot of talk about reset. I don't know. I mean, whatever. Here's my belief, and this is where we get into a lot of opinions of gold standards, other standards, crypto standards. I mean, I don't know. I don't think we'll go to the gold standard. My view is the system we have now will somehow return if we do decide that it's not going to work. Because if you understand it, really study debt-based economies over history, there's something really interesting about it. They're designed to keep the very wealthy wealthy. So so we have some, at least in America, you see some generational wealth, and you don't see a lot of people breaking into that, and you don't see a lot of people leaving it, because the system was really designed for it. It's also designed to create large governments and keep people poor. If we had a fair banking system, and what you would not see the mass impoverishment that we see today, because everyone would have equality in terms of the banking system. We don't have that. But debt-based systems were designed to keep people working. Because if you think about it, right, if I create a country and I create this, screwed up banking system that everybody thinks is the greatest thing ever, and I'm running the country, and my buddies, the three of you, we're all rich, right? Well, how do we keep people from overthrowing it? Well, you got to have them doing something, right? Because idle hands, right? That's a problem, because if they ain't got nothing to do, they might be like, hey man, those four guys are rich and they're really powerful, and I'm not. Let's go overthrow them. Well, if you get them in debt, what do they got to do? Well, they got to go to work, because what does the system say? If you don't go to work and pay your debt, we're going to take your stuff away. So a debt-based economy effectively is enslaving people. But we believe that we can move up, and we have hope we can move up, and some people do. They go from poor, you look at Zuckerberg, he's not born rich, but he's rich now. So there's some people that can, jump the system, but and maybe if you work hard and get lucky or go to school or whatever, you can move up to the middle class, or maybe go from middle to on the low end of the upper income. Look, but we give people the chance, but otherwise, look, at people got to work, because if they work, they're not down for overthrowing things. And you look through history, it works extremely well. So the idea that we're going to create equality, I'm for it. I just don't think it's going to happen. I think we get the same thing under a new name, again, where there's, we have a digital currency, and people get excited about that. I'm like, well, I have digital dollars now. They're like, what do you mean? I'm like, I don't carry cash. In fact, if I went home and I said, I need cash, I have to go ask my wife, and I don't think she has much either. I have no cash because I don't need it, right? Credit cards, phones, or whatever, it works everywhere. So if the dollar became blockchain-based or some other chain-based of things, does it matter? No. Is it inflationary? No. It's just the same system. But guess what? If we think it's different or more equal or something, hey, we can all get excited about it and then realize that no, we're all still trapped in this same system. And it's terrible. But I don't think we'll get something new, because you look around the world, everyone's running the same system. Why? Because it's really effective at what it's designed to do.
Well, here at Wall Street Silver, we all believe that everyone should become their own central bank and buy precious metals. That's a big part of our
we love the
our movement, if you will.
Yes, and I'll add to that. Try to buy them when they're low.
There we go. Well, we appreciate you a lot, Steve. Jim, Lee, do you have any last questions for Steve?
No.
This was great, and definitely a different perspective for our audience that they're not used to hearing. We're probably going to get a lot of downvotes on this video, but whatever.
No, I loved it. That was awesome.
I love it. We're going to get a lot of hate comments in the message.
I think it's so important to present different views.
Oh yeah, so do I. I love this.
Yeah.
Because this is most of the people we talk to on our channel. It's like they're like, oh yeah, silver to the moon. And here, but, hey,
Jim, you're right. You will get a lot of downvotes. That happens.
Hey, that doesn't bother me.
It does tell people when I say, look, I'm bearish in the short term. It's like, how can you be that way? It's like, look, everything goes through different cycles. And the reality is, if we have a deflationary crash and I'm right, I always encourage you to take that extra step and start asking why. Pretend you're a little kid asking your parents a question and driving them crazy. Why do metals go down? Because it's really simple. You're at the table with your spouse. Maybe you're both out of work. Maybe the kids are starving and you got no money. And you go, we got to somehow pay the mortgage or keep them happy, keep at least one guard so one of us can get a job, and we got to feed the kids. What do? Well, we can cash out our 401ks, but that involves taxes and penalties. Oh, well, honey, don't we have some gold or silver coins? Don't we have some of this crypto thing? Yeah, we do. And what form is it? It's after-tax money. And it's easy to sell. Are there people out there that want to buy metals in any type of economy, in any type of situation? Yes. I don't know how true that is with crypto yet, because we haven't gone through a major recession with it, but maybe that'll be true too. And because it's after-tax money and there's people that want it, it gets sold. That's why.
All right, we're kicking you off, Steve. That's it. No, I'm just kidding.
No, but that's kind of what happened.
I'm just
kidding.
So
people have to understand this whole go to the moon thing. You got to look back in history and see why it actually hasn't. Because I agree, you could look at the monetary base, you could look at the money supply and say, yeah, it should be higher. Yeah, it should be, but it's not. But in a deflationary crash, it doesn't get there. But here's the deal: if you could buy gold or silver at a much lower price point now, then you want to, and you want to buy a lot of it then, because guess what's going to happen? You're going to see the Fed come in and maybe do $1 trillion of QE a month. And while that isn't really inflationary, it's the inflationary expectations that will come from that are going to drive precious metal prices to the moon. And that's why I affectionately wear the Bond King crown now, but that will change. I can change the lettering on this crown. And I don't know what I'm going to call it, but it's going to have something to do with precious metals, gold or silver. And I want to be the king of that, but I want to buy it at the right price.
You got to come back next month, and we're going to talk about this some more, Steve, because I love the contrary point of view that you're bringing to this, and it's been really awesome. So let's do this again in I don't know, a month or two.
Cool. And I'd be happy to do that. Who knows? When I'm big in precious metals, maybe I'll be an honorary member of your group too. So maybe that'll happen. That'll be awesome.
Nice.
All right.
Well, thank you so much.
Thank you so much, Steve, and thank you from everyone from the Wall Street Silver community. Take care, everyone.